Top 4 classic stock indicators every noob should know. When first entering the stock market, many investors are overwhelmed by hundreds of different technical indicators. However, reality shows that you only need to understand the 4 classic indicators below to read most market movements. The important thing is not to try to find a holy grail. Each indicator only helps us look at the market from a different perspective. 1. MA, moving average. If I had to choose the most important indicator for beginners, I would choose the MA. MA, moving average, is a line that shows the average price of a stock over a specific period. For example, MA 20 is the average price of the last 20 sessions. MA 50 is the average price of the last 50 sessions. MA 200 is the average price of the last 200 sessions. Many people only remember that MA is used to identify the trend, but the deeper nature is that MA reflects the average cost basis of the crowd in each period. When the price is above the MA 200, it shows that most long-term investors are in the money, profitable, and the long-term trend remains positive. Conversely, when the price is below the MA 200, selling pressure tends to increase. A simple way to use it: price, MA 200, prioritize looking for buy entry points. Price, MA 200, be cautious with new positions. However, MA is not always right. During a sideways market period, MMA often creates quite a lot of false signals, noise. 2. RSI, Relative Strength Index. If MA tells you which direction the market is going, RSI will tell you whether that trend is strong or weak. RSI fluctuates from 0 to 100. The 2 most famous milestones are: above 70, overbought; below 30, oversold. However, this is also where many beginners misunderstand the most. An RSI above 70 does not mean the stock will drop immediately. In fact, the strongest stocks can often maintain an RSI above 70 for a long time. Therefore, RSI should be used to assess the strength of the trend rather than trying to predict tops and bottoms. A more noteworthy signal is the phenomenon of divergence. For example, the price creates a higher new peak, higher high. But the RSI creates a lower peak, lower high. This indicates that the upside momentum is weakening, and the trend may be about to reverse. 3. MACD, Moving Average Convergence Divergence, Trend and Momentum Indicator. A CD is one of the most widely used indicators in the world. The simplest way to use it is: MACD crosses above the signal line, buy signal. MACD crosses below the signal line, sell signal. But the more important thing is to understand what MACD is measuring. MACD does not measure the stock price. MACD measures the change in the velocity of the price's rise or fall. In other words, MACD helps investors recognize when the trend's momentum is strengthening or weakening. An important note: MACD is a lagging indicator. This means signals usually appear after the trend has already started. Therefore, MACD is more suitable for confirming trends than looking for buying the bottom or selling the top. Bollinger Bands. If MA helps identify the trend, RSI measures trend strength, and MACD measures momentum, then Bollinger Bands help us assess market volatility. Bollinger Bands consist of the upper band, the middle band, usually the MA 20, the lower band. When the market is highly volatile, the bands will expand. When the market is consolidating and trading in a narrow range, the bands will contract. This is why the Bollinger Band squeeze phenomenon is highly watched by investors. When the Bollinger Bands narrow for a long time, the market is usually accumulating energy for a big breakout ahead. However, Bollinger does not tell you which direction the price will break out. It only warns that a strong volatility expansion is likely to occur soon. A common mistake for beginners is seeing the price touch the upper band and immediately selling, or touching the lower band and immediately buying. In reality, in strong trends, the price can completely ride the upper band or lower band for a long time. Conclusion: no indicator is 100% accurate. MA helps determine the trend. RSI helps assess trend strength. MACD helps track momentum. Bollinger Bands help measure volatility. Instead of searching for a perfect indicator, investors should learn how to combine multiple tools together to get a comprehensive view of the market. That is the way to use technical analysis effectively in practice.